What's up, guys? cryptoFOXXY here. Thanks so much for stopping by the channel. So we are live streaming right now, awaiting Jerome Powell's speech after the FOMC decision, the Federal Reserve interest rate decision, obviously today, and we're waiting to hear what Daddy Powell basically has to say today, because we hang on every word he says because he's just so amazing. Not really, but. We try to decipher how he feels about the current state of the market. And I know they've had a lot of ups and downs in terms of how they think inflation is going, right? And especially with what's going on with trade and tariffs right now. So I'm kind of interested to see what his views have been on how tariffs are impacting inflation in the United States. I'd love to hear what he's going to say here today. Just kind of gauge interest and how they go about, determining whether to, to lower interest or interest rates, et cetera. It's just always fascinating to hear about their thoughts on the economy because sometimes we think it's going one way when really it could actually be going another. And they have you know, more than one thing that they look at when they're determining which way to go with interest rate decisions. So it's very fascinating always to hear because sometimes they'll say, oh, but jobs, right? They'll look at the jobs numbers and be like, okay, well, we have to do this. And then next time it's the opposite. It's like, oh, the jobs did this again, but now we're going to do this. And this is why. And it's like they just change everything all the time. And it's just such a complex decision. It fascinates me. So stop speaking about things you don't know. Great. Thanks, Crypto Ken, GK, whatever the hell your name is. Well, you know what? If you don't like what I say, you know where to go, somewhere else. So uh, we don't bother with people like that. So, anyways, if you have anything constructive to say, please feel free to leave me a message. Obviously write a comment and I will be happy to talk to people who are, somewhat coherent. So this is what's going on with Bitcoin right now. Just watching the charts this is on the 10-minute chart. I've just been trying to see, I feel how the chart's going to move, but it's going to ebb and flow in the next few days, guys. It always does this after the FOMC decision. It's going to, digest the information that it hears from Powell. So where it's at right now could be completely opposite from where we're at in about an hour's time. So I don't really tend to trade FOMC days unless it's something that I'm pretty sure about. So I'm just kind of sitting back watching what's going on at this point in time. So let's take a look at what's going on in the news today. Bitcoin holds, as they were saying, it was holding 113K. But the chart is saying 111 right now. We've dropped down quite a bit. Signs emerged that the government shutdown crisis in the U.S. may soon be resolved. After nearly a month of being shut down, there's a lot of people waiting to get paid. And I don't know about you guys, I don't like to work for free. So, they got to get this sorted out and they have to figure out how to get these people paid. I know there was a big donor that donated for the troops to make sure that they have gotten paid, but people rely on food stamps and a number of other things, and those people are going to be really feeling the pain from this. It's something that they got to get figured out. And they want. It's a too bad situation. It's one person doesn't, not one person, but one party doesn't want to uh, compromise, really. It's a lack of compromise why the government is shut down right now. But anyways, Republicans have proposed expediting bipartisan budget packages. Geez, who wrote this? Once the government reopens, the first would include funding for Department of Agriculture. Second, well, that would be good for the farmers because I know they're definitely hurting as well. And the second would cover the Department of Defense and Health and Labor. Those are your most important sectors, really. The proposal's yet to convince Democrats, so we'll see what happens here. So the Democrats' biggest concern about the shutdown is healthcare. It says Donald Trump's willing to meet with Democrats to discuss extending Affordable Care Act with the Obamacare subsidies if the government reopens. So they just got to get this figured out, in my opinion. I think, it's just hurting more of the everyday people who are already struggling anyways, and the rich aren't really impacted so much. So it's not really a great thing for the country to be having shut down like this. And, quite frankly, I mean, even in Canada, when we see our government take vacation and things like that, like kind of the same situation, but they don't stop paying people. Like you just can't mess with people's livelihood and their income, etc. It's just not a good thing. So what's going on right here now? Doing a great job. Thanks, BM. Appreciate you. Nice, nice handle too. That's awesome. So you're saying Fetch AI and Mobix is the future. Nice. Appreciate that. Thanks. Um, yeah, so taking a look at some more news here, see what's just going on. I'm just kind of, biding some time till we get to the Jerome Powell's speech. That's in about 8 minutes time. So, oh, this was interesting. Zach XBT claims Blockdag's value is a cover up. He actually, let me see if I can find that for you guys. Zach. He claims that, let's see here, the Blockdag founder is a different person. So this is who they're portraying as the founder. A message from our CEO, Anthony Turner. So, blue collar, white guy kind of thing, oh, he looks pretty respectable, blah, blah, blah. I don't know what the whole purpose of this is, but apparently Zach XBT says it's a different guy. He's secretly behind Blockdag, and he pays people like Anthony Turner to be the face of it while transferring away millions in pre-sale funds from unsophisticated retail investors via Middle Eastern OTC brokers. And apparently he has a background for, I believe it was wire fraud as well. Very, very interesting scenario there. So, so back to this here. He revealed the real co-founder is actually a guy named Gerhan Kilzoz, and Kilzoz was previously accused of funneling millions of dollars pre-sale funds. That Anthony Turner was only acting as the public face of the crypto project. That is very interesting. You never know who is behind things, right? Yes, you could have certain people running things. Well, I mean, look at the U.S. government in the last 4 years, right? Biden was basically an auto pen, so absolutely crazy. I was listening to some of that news today as well, and it's very concerning. And that's going to be a Netflix series here in the next few years, I would almost imagine. Just the theatrics of it all is absolutely insane. Let's see what else we got going on here. See what's new. Bitcoin, Ethereum shrug off central bank's interest rate cut. All right, let's just take a quick look at this. This is the first time I'm reading these guys, so just give me a sec. Central bankers dropped the rate that banks charge each other for overnight lending. Reserves held the Fed to a range between 3.75 and 4 after jobs data and other economic indicators pointed to a slowing U.S. economy. September job report showed employment remaining around 4.3, a 4-year high. Inflation remained above the bank's target of 2%. The CPI rose to 3 in the 12 months through September. The Bureau of Labor Statistics said continuing an upward trend that began after 2.3% reading in April. Interesting. Investors are awaiting Fed Chair Jerome Powell's comments on ending the bank's quantitative tightening. The bank has been unloading treasuries and mortgage-backed securities as it aimed to bolster financial markets and wrestle inflation under control a few years ago when the economy was on shakier ground. Now, less restrictive monetary policy with a higher tolerance for inflation, coupled with lower interest rates injecting liquidity into markets, could bolster Bitcoin and other risk-on assets, say some analysts. The Fed slashed the federal funds rate by 0.25, its first cut since last year. This was last month. And Trump continuously threatens to fire Jerome Powell. I keep going back. I'm just making sure that the press conference hasn't started yet, so I'll make sure to switch that over once that starts. Should be in the next 5 or so minutes. So we're just going to kind of take a look at what's going on here. I saw this here, Western Union, one of the oldest payment companies, announces entry into the crypto market. I thought they already had, but I was actually thinking that was MoneyGram, because MoneyGram was partnered with, I believe it was XLM. And so Western Union now getting into the mix here. Um, The new digital asset called US Dollar Payment Token, USDPT, will be built on Solana and issued by Anchorage Digital Bank. Western Union states its more than 100 million customers will be able to transfer money internationally through this token, independent of local currency risks. And the launch is expected in the first half of 2026. So instead of incorporating already existing blockchains, it looks like a lot of these companies are wanting to kind of build their own, which is a little bit concerning for some of the narratives that some of the cryptos out there have right now. Because some of them, some investors are sitting there waiting, all this, we're going to get incorporated into some big company or whatever, and just waiting for some big, massive pump. And then companies like this just turn around and are like, yeah, we're just going to create our own. So, is what it is, I guess, right? Oh, and then we had HBAR ETF. I actually got to do a video on this because I meant to do one yesterday. HBAR ETF goes live on NASDAQ during the U.S. government shutdown. Absolutely cool. Very excited for HBAR. HBAR is one of my, up there holdings. It's definitely prominent in my portfolio. But the first U.S. ETF launched on NASDAQ under the ticker HBR, giving investors direct spot exposure to the HBAR coin. Well, HBAR token via regulated brokerage accounts. Canary Capital HBAR ETF debut marks a major step for institutional crypto access. So that was really cool. The community has been waiting for this to happen. And then with the government shutdown, we didn't think that any ETFs were really going to be approved. All right, so here is the interest rate decision. They cut by 25 basis points. Okay, so that's basically what we were thinking. I think the market was hoping for a bigger cut. Obviously, we always usually are. But, the Fed is reluctant to do that. And it's going to be interesting to hear Powell's speech because, a number of analysts and people prominent in the financial world think that there should be more obviously we know Trump's stance on it says that he calls him too late. So he thinks he's going to cut too late. So tea. Gonna have my tea. A new member of, excuse me, a little stuffed up today. Some members believe the rate cutting cycle should continue. Others believe there should be no rush. Some want more cuts immediately, while others advocate a wait and see approach. So they have a little bit of, conflict there in their interest rate decisions. The new member, Stephen Moran, who called for a 50 basis point cut at the September meeting, he cast the sole dissenting vote in a vote where the majority supported a 25 basis point step, was expected to advocate for a more aggressive reduction this time around. So maybe things changed and they're kind of, looking on another wait and see, right? And, that could be what's going on there, but okay. Oh, hey, Boca, what's up? Boca GXRP. Hey, man, that rhymes. Nice job. Boca's a good buddy of mine. Thanks for popping on the stream, buddy. It's awesome. NVIDIA and telecom. Yes, I did see something with that as well. If I got time, I'll touch on that too. Hey, Bandit, how's it going? Hope you're doing well as well. The One Leg Bandit, he's a good buddy of mine. Go check him out on X. He's on YouTube as well. He does videos, live streams, etc. So the 25 basis point cut. Yes, that's what we ended up getting. That's kind of, it is what it is, right? I mean, I wasn't expecting some big massive cut today. It's just, Pal speaking. I'm going to go over to him. Just 1 second, guys.
Remains somewhat elevated. In support of our goal,
let's just backtrack.
The American people.
Okay.
Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today, the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Bitcoin's down around 110.4 right now. It's
Nick,
not digesting it so good so far.
Are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, other people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
You know, I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. You know, I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, you know, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, you know, that we haven't made a decision about December. You know, I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a
That's
quick
interesting.
follow-up
He
on
doesn't
QT?
usually
How much of the
mention that.
the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
You know, that could be one of the factors, but the reality is we've seen, you know, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, you know, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place.
It's
The other
probably
thing
tariffs.
is, you know, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice. And so there's not a lot of benefit to be holding on to get the last few dollars because, you know, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, you know, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, you know, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, you know, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, you know, that would certainly play into our decisions going forward. So, we do have, you know, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get, you know, job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and you know the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So, you know, we get like I mentioned what we get in the labor area. We get some data in inflation and some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the, the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this.
Oh, so he doesn't need the
In terms
data?
of how it might affect December, it's really hard to say. December's,
just wing
the
it.
meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then, that could be an argument in favor of caution about moving. But we'll have to see how it unfolds.
Steve.
Every time he says data, you have to
Steve
drink.
Richmond, CNBC. Mr. Chairman, can you characterize the
This is tea, by the way.
in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So
We just talked about that before
was a
this
strong,
started.
solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet.
That was on Saturday, Boca.
If you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're
Word of the day,
that we're
shrinkage.
managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
John,
Bitcoin's
Marte with Bloomberg. How are
sitting at
officials
about 110 and a
interpreting the
half.
latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
They're not going to say they're going to make a mistake.
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the 3 components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news, that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come and it probably will increase further, but it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Yeah, how long is it going to take to get there is the
Thank
question.
you. Chris Rugaber, Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. Could you mention that you do have data that you're looking at for inflation and growth in the absence of government data? Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the beige book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think
It's probably
if
better.
something material were
I mean,
happening, if there were
really.
material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard?
AI data has probably transformed how
Howard
they
Schneider with our Reuters, thank you.
view their data,
I
really.
just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more
this guy.
difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the beige book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it, and that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully. And yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are. If you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspectives of people on the committee that, we've now moved 150 basis points and that we're down into you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether, in fact, the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
And so on that division, then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed
Equally as
to
important.
doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just
Deportations.
a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand.
I guess they got to stop hiring illegals.
So the unemployment rate has gone down, meaning that demand for workers is going down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and I would just say when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. So it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain.
This
and
is what I was
finally get
waiting
to
for.
Consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in, February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think, some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be
Unless
at
the
that level.
tariffs
And
keep
then
going up.
Measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy.
Cameraman all fucked up there.
And it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable, whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. And
Say he was talking about repos earlier.
You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not, it's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI, of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about, it's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies. And, so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and, it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing, and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers, or maybe skewed that way. But the consumer is spending, and that's a big chunk of what's going on in the economy.
Are they
bigger
spending
than-
money they have, or are they
substantially bigger
spending with debt?
than AI. You could point to growth. I mean, actually, you may be growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs, because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian. Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, there's no story. You can look at
Any
the
short
numbers.
circuit?
Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is that, you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed.
You need
is
tea,
very low.
Boca.
But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular
That we're
section
thinking
of the
of?
labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney.
Obviously.
Hi, Chair Powell. Courtney
Things
Brown
go up,
from
but their payments
Axios.
don't.
As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, you know, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two, and so it's a challenging thing, and, you know, as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, you know, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, you know, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. You know, I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, you know, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, you know, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank
you so
God.
much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, you know, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. You know, we're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But, you know, we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, you know, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll, you know, dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
Interesting. All right. So, blah blah blah. Data. We don't know what we're doing in December. We'll have to see the data if we have any, blah, blah, blah. Pretty much the same as usual. But we'll go over some of the TLDR points here that Powell has made. So he's suggesting that the current data that they have, which is a little bit hard for them to gather right now since the government is shut down, right? There's data's not being compiled. Some of the resources that they use to determine, rate cuts, et cetera, some of that data has not been produced. So they're having to go kind of by a whim, right? So, reluctant to go any lower than 25 basis points for this session. So that's understandable. I mean, I think, we kind of expected that. The market had 25 basis points baked into the market. We weren't really expecting to get anything more than that. So it's not really surprising, to be honest. And his whole speech wasn't overly surprising either. He says that the labor market appears to be gradually cooling down, but it's not worrisome. It's not. It's not dropping. It's nothing really to really worry about right now. It's just gradually moving. Inflation levels are still remaining slightly high above their target. The current data shows the economy is growing moderately. They're starting to see the impacts of tariffs, the first tariffs that have been issued months previous. They're now starting to see a little bit of impact from that, but it's nothing overly worrying, I believe is how he kind of put it. Layoffs and hiring are remaining low, so there's not really any new jobs really out there, for people that are. But we did see the layoff. We did see a number of layoffs coming from some major companies recently. Just the other day, Amazon, a number of different companies are laying people off. They said downside risks to employment appear to have increased. Inflation expectations have risen recently. We also have. He also said that they don't have any inclination of what's going to happen in December for their next FOMC meeting. Obviously, the data's changing kind of day by day, so they're going to have to kind of wait. It's not certain whatsoever. He always says that. That's not surprising. He also said that the interest rate cut is another step towards a more neutral policy stance. And let's see what else is here that is relevant. December marks the next phase of the balance sheet process, which will remain stable in the long term. The October rate cut follows the same risk management logic as the September rate cut. So that tells me that nothing much has changed since September. That's not a whole lot anyways. The situation will be different in the future. I mean, that's a given. They're having a hard time addressing both employment and inflation risks with one single tool. They're having to kind of make almost like making compromises on either side. It's like they want jobs to remain, they want people to have jobs, right? They want the job market to be strong, but they also want inflation to come down. And it's kind of like when they do one thing, it affects the other. So it's kind of like this teeter-totter with one person that might have a little bit more weight on it at one time, right? And it's kind of like it's not quite balanced yet. So let's see, what else has he got to say here? Yeah, the crew of the debate lies in the future. That's interesting. I'm just looking at some notes here that were made during the speech. But yeah, that's just pretty much the TLDR. I mean, nothing really shocking. We're not really nothing that we didn't already know really going into it, that they're going to have to look at the data for the next FOMC meeting and figure out kind of what they're going to do then. It's going to be a as you go scenario because, like I said, government shutdown is and that brings up a really good point. Actually, I wanted to talk about this. I thought about this during the speech. Blockchain data. I mean, why is it contingent on government to report? Like, why is the government relying on their own information, right? There should be some kind of a neutral party out there or something that's very verifiable, and transparent, such as blockchain. And I know they've already started to use blockchain in some instances in regards to their data for especially, inflation and things like that. But using blockchain for some of these data points would make it so that, if government is shut down, then there's not, you know, a holding of all this data that they need to make decisions, right? FOMC still has to run. There's a number of different, you know, different use cases there that they could use this for. And, you know, getting out there and pushing into the blockchain world, I think is a very good step for the government. I think that they need to start using some of these tools that they have available to them. And, you know, it just really, it's that third party, you know, no intermediaries, nobody is really in control. It's the data is the data. And I think that that's what we really need to see, because, you know, looking back in the summer, all those jobs reports that we got, a lot of them had been amended afterwards, right? And, you know, they're getting incorrect data, and they're getting it because certain people are controlling that data. And I mean, really I mean, we're in, you know, 2025, we need to start using the tools that are available out there and getting things up to date. Same with banks, you know, same with a number of different tools that we have out there that we've been using for years that need to be updated. The financial system is in a huge need of some change. So anyways, that's pretty much what I got for you guys. I know it was a bit long, and, you know, Powell seems to kind of rant and go on and on about the same stuff. I mean, they ask him a lot of the same questions too, right? You know, they try to get him to say something that he doesn't want to say, and, you know, in his outlook towards the next rate cut, or, you know, rate hike, or whatever it is they're going to do, their decision anyways. And, you know, he's not very forthcoming when it comes to, you know, to divulging any of that information, because he really doesn't know. And I think he tries to play the neutral stance, you know. He doesn't have any bias, that kind of thing. And, you know, it is what it is. I mean, you're not going to get much out of him. He's been around the block. He's been doing this for a gazillion years. I mean, he looks like it with all that that gray hair. I shouldn't say a whole lot, but anyways, all right, guys, I got to get back to work. It's been a slice, and I know I need to go get another refill on my tea. So I'll catch you guys in the next one, and have a great rest of your day. Peace.